to this edition of Mortgage Mondays. In this one, I want to go over conventional loans. Here's why. Obviously, it's a very popular loan. It's the one most people know about. It is something that we do, and a lot of people don't think we do because we push the self-employed mortgages or the non-QM mortgages a lot. And again, the reason we push those a lot is because we feel it's an underserved segment of the market looking to buy homes. Now, we do those, and we also do conventional loans as well. And I wanted everybody to know that we do them. Okay. So with that being said, I'm going to share my screen, guys. I've got a new little PowerPoint presentation this week. Hopefully you like the new aesthetic. Let me know if you don't. We'll have my PR girl change it up. If you like it, I did it. If you don't like it, I didn't do it. So with that being said, we are Merchants Property Solutions, fully licensed mortgage bank, not a broker. Bank means we do the underwriting in-house. Very few things leave my house, as I like to say, that it's underwritten by another bank. We do have other products we broker out, but 95% of our loans are banked and underwritten in-house. Now, we also are licensed in 38 states. When it comes to primaries and second homes, you do need to be licensed as a bank, and you do need to be licensed in the state. When it comes to investment properties, we do not need to be licensed in the state. We just need to be licensed as a bank. So we have all of that covered. The only states we don't do, smaller states, the Dakotas, couple stuff in the Midwest, stuff we didn't feel was fine, that loans are maybe too rural or not financially worth it to do, or worth the time, because it does take time, effort, and money to get licensed in states. So, we made a decision as a company to only be licensed in 38, and hopefully New York will be coming soon. Okay, so this is me, guys. Quick little bio about myself. I have been with the Accredited Group, which is the parent wholly owned subsidiary, one of the partners in Merchants Property Solutions. All right, I've been here for 4 years. Went to Hofstra, been doing this for a long time. There's a quick little bio on me, guys. Next, conventional loans. Let the fun begin, kids. All right, so a conventional loan, by definition, this is from the CFPB. Who's the CFPB? That is the people that watch me. That's the watchdog of the mortgage industry. They make sure that we keep our, ourselves clean, that they're responsible for us getting background checked, fingerprinted checked, FBI background checks, state background checks, and fingerprinted and credit pulled at least once a year. Okay, so a conventional loan, any mortgage loan that is not insured or guaranteed by the government, such as FHA loans, VA loans, and USDA loans. So pretty self-explanatory. The biggest part of conventional loans is Fannie Mae and Freddie Mac. They make all of the guidelines. They make all of the rules to which mortgages can be closed and sold on the open market. We adhere to those guidelines, and keep this in mind, team. Guidelines from bank to bank, whether you go to a Chase Bank, a Manhattan Bank, or your little regional bank, sometimes there are very little differences in A, the rate, and B, the guidelines. Yes, you could do something that goes above and beyond. For example, a Chase Manhattan may want you to have a 720, where I'll go down to a 620. Okay, a Wells Fargo might decide to not use business owners, okay, or only let W-2 people. You can always make the guidelines, you can always tighten the guidelines on conventional loans. You can never, loosen them or change what Fannie and Freddie do. If not, it cannot be sold, on the open market to most investors as a Fannie Mae or Freddie Mac loan. Okay, so again, whether you go to Bank of America, whether you go to Chase, or an individual like myself, most of the time the guidelines are the same. So some of the key highlights: it is full documentation of income. There is no wavering for this, no saying, oh, let me use my bank statements. Oh, I went stated back in 1982. Doesn't work like that anymore, guys. No more handshake loans. No more of that. No more, hey, I have good credit. Why do I have to prove my income? Or I got a ton of equity. Does not work like that. You could either prove your income or you can't. And how do we prove income? I'm going to go through the documents later on. How you prove income is tax returns, W-2s, all of that happy, fun paperwork. Debt to income, 50% on what we call the back end, meaning all of your bills combined, including your housing payment and anything that comes up on your credit report, any child support you may have to pay, any judgments or liens that show up or don't show up on your credit that we might see on the title pull, those have to be included in your debt to income ratio. All right, so again, no wavering from that. There is no saying, hey, well, I got a 51 or it's 50.01. Sometimes it'll go through, but guys, I'm speaking in generalities. Of course, sometimes things will go through, but I'm giving a very quick overview. I could talk about mortgages for months, years, days. And again, I'm doing very brief generalities just so you guys can get an idea of the mortgage space and some guidance. This way you guys know. But for the most part, I'm here to qualify. If it's over a 50 DTR, of course, we'll look at it. But again, there's no 55, 60s or 70s getting pushed through. Once in a while, a 55 and FHA will get pushed through, but that's a whole nother segment. But for conventional loans, you are capped at 50. Now, down payment, biggest hot button right now. What is the minimum I can put down? There's a lot of questions that I get. Well, when it comes to a conventional loan, they do have a program where you can put 3% down. Most of the time, people put at least 5 down because it does change the mortgage insurance premium. But keep in mind, all of these loans, if you do not put 20% down, you do have PMI. There's no way around it. You have to pay private mortgage insurance. It protects me as the bank. It doesn't protect you guys. You guys have homeowners insurance. Or if you have any other disability insurance, or God forbid something happens to you, you lose your job, or come into an extenuating circumstance, that's on you. But for us as the bank, any loan where you do not put down 20%, you have private mortgage insurance, PMI. Again, there's 1 or 2 ways around it. I'm giving you generalities. If there's anyone here that know mortgages, again, I'm giving what we call an elevator pitch here, guys. Very quick, basic guidelines. Just helping you guys get to know the product better. You'll become experts in time. But again, I don't want to do this all night. I know you guys don't. I don't mind. This is what I do. But like I said, I can keep you guys in here for weeks talking about mortgages. Cash out refinances, which are few and far between right now. 80% max loan to value. And they're cutting that a little bit too. They're making the rates much higher. They're doing a polite way of saying they don't want to do 80%. They're making the adjustments to those rates a lot higher. Because again, team, keep in mind, the less money you put down, the higher your debt to income, or actually the lower your credit score, and the less you put down, the higher your rate goes, or the less, in the case with a refinance, the least equity you leave in your home, the higher your rate. So example, an individual who leaves 40% equity in their home on a cash out refinance will get a better rate than a person that leaves 20% equity in their home. Again, keep in mind, loan amounts are virtually the same and credit scores are virtually the same. Everything else being even, but we call the loan to value, they will get a higher rate. Credit score, minimum credit score for me, friends, is a 620. Okay. FHA can go lower, but this is not FHA. This is conventional loans. All right. Conventional loans have a lot of minimums. There are sometimes some ways to go down, very rare circumstances. Most of the time it won't get to approve, which leads me to the next bullet point. Must receive and approve eligible. Okay. So all of that being said, you have to receive something called approve eligible through the Fannie Mae, and FMA is the acronym for Fannie Mae we all use, through the AUS, Automated Underwriting System. That is almost like a pass or fail system, team. It analyzes, they say, a couple of 100 million data points from the information I put in the computer. And of course, we make it accurate. We don't want to get a false positive, like a blood test. False positives are no good. You don't want to mess around people's lives. You're talking about their biggest asset that they'll ever have in their lives for a lot of people. You don't want to mess with their emotions, their house, and their money. It's not polite and it's rude. It's not a good way to do business. So you must receive and approve eligible, pretty much saying, okay, you're good to go. Put a loan to your underwriter. Let them make sure all the documents you entered are accurate, and we'll give them the loan. Okay. Now, types of property. Not much you could do with Fannie Mae. They're not exciting when it comes to this. They don't think outside of the box. Very, very vanilla, cookie cutter and plain, like an assembly line. They'll do single family homes. They'll do condominiums, and those condominiums have to meet certain numbers. For example, if you have a condominium, and that condominium, let's say in Florida, where there's a lot of investment properties and second homes, most likely will not meet Fannie Mae eligibility guidelines. When you buy a condominium, you need two things need to be approved. The condo, or in this case, sometimes the co-op. I gotta put co-ops in here. I add that next time. The co-op board, and well, the co-op as a business and the condominium as a business also need to be approved. So you could be an ACEs borrower, you could be the best borrower in the world, 850 credit score, a 1% debt to income ratio, putting down 50% on a condo. If the condo association or that community or that property, some of the other people, things that they call condos by, if that does not meet Fannie and Freddie guidelines, not getting in that place, it's not you that we're not lending to. We don't like the condo itself as a business or the co-op. Condos and co-op, guys, similar, but they're not similar, if that makes sense. But they still have still the same basic principles. The association as a business needs to be approved, and the borrower needs to be approved on condos and co-ops. Multi-unit properties, all right? 1 to 4 units, guys, nothing over 4 units. It can be investment properties, okay? We do use the income. Let's say you're moving into a 1 unit, okay? Let's say you're moving into 1 unit or an investment, whatever the case may be. If you're buying a 4-family and you're moving into 1, we will use the income of the other 3 units. We'll use those to qualify you. So the income can be used. So, there are people that are buying in here in New York. Some of these 4 families are, 1.2 to almost $1.5 million. Guy's making some money. He wants to buy his first home as a 4 unit as an investment. No problem. On paper, by himself, they may, or he or she cannot afford that $1 million or $1.2 million. And they're using the income from the other units. All right. So it's allowed. We do it all the time. It's perfectly up to par. It's not something that's out of the ordinary. It's done all the time. There are tons of guidelines on multi-unit properties and how to use their income for my underwriters to go by. So there are tons and tons of ways to include that. Okay. For all my friends in the outside of metropolitan areas, manufactured homes are a very big thing. They're becoming very popular. They're becoming big, and they're becoming a lot more expensive. Everything from these container homes to my sister, I believe, bought a manufactured home up in Sackett's Harbor, New York. Came in pieces. And some of these places outside, where the winters are rough, like up by her, there was the lake effect snow. So it was easier for them to build the home in a huge warehouse and bring it in pieces. Otherwise, their construction, the weather would only be construction friendly for maybe 4 months instead of 12 if you have a manufacturer that can be built, and then it's trucked out to the site. Right now, there are guidelines. It has to be manufactured. It can't be mobile. It has to be braced and permanently attached to that foundation. We call them hurricane straps, and it has to be called a HUD tag, HUD. Housing and Urban Development. There's a tag, okay, that gives certain information like serial numbers, manufacture date, I believe inspection date. I don't know off the top of my head, but the guidelines are at the tip of my fingers, guys, whenever I need to know the stuff. And girls, manufactured homes, there are some criteria, but we can do them. All right. They can be done. They're not as hard as you think. People think manufactured homes, co-ops, very difficult to do. They're not. A couple of more hoops to jump through, a couple of more guidelines, but they're really not that much more work if you have anybody looking to buy them. It's really more work on our end. It's a little more paperwork, but it's it can be done. Okay. Now, guys, load up in the Q&A. Robert, I love Mondays too, Robert. Thank you. Start loading up questions in the Q&A, guys. As they come along. I don't want you guys to forget. If you have a question now, load it up in the Q&A. You know me, after I go through all the slides, I'll answer the Q&As. Okay, so occupancy types. You have a primary residence, right? Somewhere you're living full time. That's where you lay your head at night. That's where you go every night. That's where your bed is. That's where your home is. All right. You're staying there majority of the year. Second homes, property that we use by borrower as a vacation home or secondary residence. You know, you're there, you're not renting it out. Like I said, for us New Yorkers, we call it snowbirding. You might have a home here in New York, might have a home in Florida, you know, where you go when it's snowing up here. So that's the second home. All right, and then you have investment properties. All right, this is a property you do not intend to stay at all. It's strictly for investment purposes. You know, you're charging rent, you're generating money from it. It's strictly, again, an investment. It is something, again, you're not staying there at all. All right. And down here is a very important note. You know, it's important to note, you know, the less time you're staying there, guys, think about it. The less time you're there, the riskier it is. Because if you run into trouble, let's say with your job or the economy, which loan are you not going to pay first? Look at the screen. It's going to go in order. You're going, you know, top of the food chain is getting fed first, your primary residence, then your second home, then an investment property. If, you know, crap hits the fan, you know, recession is looming right now, people still paying their rent, which they may not be able to pay either. What's going first? If you lose your job, you're using your rent money to pay your primary, even though you're not supposed to. You're going to. It's human nature. You have to protect your family first. Same thing with a second home. So think of it this way. The less time you're spending at a place, the higher your interest rate will be, and the more your down payment has to be. So less time, more down payment, higher rate. Less time, more down payment, higher rate. They move opposites. All right. So again, keep that in mind when you're talking to somebody. You know, if you're talking to somebody and they say, hey, I want to buy an investment property, I have 5% to put down. You know, I don't have any programs and I've never seen it. Well, actually I have, I'm sorry, in 08, why we had a big financial crisis. You could get away with almost 100% financing on an investment property, maybe 95. You know, those programs are long gone, team. Long gone, goodbye, kiss them, never coming back. If they did, I'm heading for the hills because that's just a combination for a mess. All right. So again, the less time you're spending there, the more money you have to put down, the higher your interest rate. Why? Because it's a higher risk. All right. Now, that's non-QM, foreign national, and that's really all I have to say about conventional, team. As usual, there's my contact info. Jot it down. You know, most of you on here know how to get in touch with me, have gotten in touch with me. Again, the Q&A, fill up the questions. Let's see, what do we have? Hey, Lee, I have a client that's building their primary home and have paid $800 to build and need another $400K to buy out and move in. What do you recommend for a loan? We have a construction loan. All right, we do have a construction loan. They do not need to have any experience. They just need to have, you know, some of my investors is 680, some of them are 660, depending on the scenario. Email me the scenario or call me. You know, all my contact numbers, I'm pointing right over here, but if you look on my screen, you know, click that QR code. It'll give you all of my contact information. Get in touch with me after this and I'll go over the particulars. There are a ton of questions I have in order to give you accurate answers. So yes, we can do it. If it's not fully done, you know, you can maybe do a home equity, but I highly doubt it's done. It's probably, you know, there's probably a lot of work to be done if they need to do 400,000. So get in touch with me. We'll find out what we need. We'll call the client together and we'll find out what we need. Nathan, I believe the average rate as of today might have been 6.25 throughout the country. Don't quote me on that. It does change every day. Team, keep in mind, interest rates change every single day. My rates come out about between 9:30 and 10:30, depending on which investor I'm using. And again, guys, yes, we do sell our loans. We do have investors, we sell them. We underwrite them. The investors buy them from us. Okay, we are a mortgage bank. Like any other bank, we do sell our loans. So, Nathan, I believe the average rate is 6.25 right now. All right. Again, it could be higher. If it's an investment property, guys, it's going to be higher. If it's a cash out, it's going to be higher. All right. If your credit score is lower, it's going to be higher. So there are something that's called loan level price adjusters, guys. I get my base rate and they'll say, oh, okay, Manny has X credit score, I'm adding this on. Manny is only putting down 5%, I'm adding this on. Oh, Manny's putting down 30%, I'm taking this off. Oh, Manny's got an 800, oh, I'm taking this off. So the better your scenario, obviously the better the rate. It's not cookie cutter. It's not cookie cutter the rates, guys. I mean, it is cookie cutter that everywhere you go, if your scenario is the same, your rate's gonna be very close. But it's not cookie cutter that every single scenario gets the same rate. You know, I go by a chart, I go by, you know, all right, here's your loan to value, here's your credit score. When they meet, that's your rate. So that's how we look at it. Nathan, you are welcome, my friend. Anonymous, I missed the states you don't loan in. Guys, you can always check us out on NMLS. That'll be the states that we're in. Again, we are fully licensed, fully tracked. We have to do a bunch of reports depending on the states, either quarterly, some weekly, you know, at the very minimum yearly. So you can go to NMLS, Nationwide Mortgage Licensing System. That is where you can see all the states I'm licensed in, guys. So again, just a quick recap. If it's an investment property, considered a commercial loan, I could do all 50 states, including the District of Columbia. So that's 50 states in one territory. If it is a second home or a primary residence, I can only do 38 states. Okay, we're the only state that's big that we're not in right now, which we're probably weeks or maybe a month or two away from getting, is New York State. All right, New York State is the biggest state that I'm not in right now. Why? Because they take forever. You know, it's been a 5-year process. It really takes forever. So, you know, but we're right there. All right. So again, you guys know NMLS, Nationwide Mortgage License System. And that is where you can see the states I'm in. Anonymous attendee, you are welcome. Do you loan on manufactured homes that will be used as rental properties, not a primary residence? That is a great question. I have to look at the guideline. So I look at co-ops and manufactured homes as the same, just because a lot of the guidelines, not the same type of property, but a lot of the guidelines. I'm 50-50 on that. Dan, if you could email me right now, I'll find that answer out for you. If they're going, definitely not. If it's a non-QM loan, meaning not Fannie Mae, not proving income, not DSCR, I can't do any, I can only do manufactured homes through a conventional mortgage. Now, I'll find out about the primary or second home. I think I can, but there's going to be more money down. All right. I will find that answer out for you. That's a great question. Stay tuned for that one. I will find out for you, Dan. So shoot me an email right now, Dan. Manny at GetMPS. That's merchantspropertysolutions.com. Manny at GetMPS.com. And I will get it to you. All right. So I answered that. Again, guys, as usual, thank you for your time. If there's any more questions, let me know. I'm going to stop the share right here. Let me check Facebook, see if there's any questions on there. So no questions. All right, good. So, all right, guys, if there's no more questions, let's see one more Q&A. You are welcome, Edwin. So, guys, like I said, you usually like to keep it around a half hour. We're at 33 minutes. Like I said, there's so much more to conventional mortgages, team. There's so much more I can get into. I could bore you guys. I could talk about what I know for days, all the things I've seen. But the good thing is guidelines are forever changing. So my job does not get monotonous. Otherwise, I wouldn't be doing it. I would not be doing it, you know, this long if it was, you know, if I was bored, because I do have ADD, part of being a sales guy usually. But again, team, any questions, you know, hit me up privately. You guys have that, you know, have all my contact info. Hit me up on Facebook or whatever needs to be done. Carrier Pigeon team. Again, have a great evening, guys. See you all next Monday. Stay tuned for our special guest next week. I will have a realtor. Next week, we're going to go over the importance of getting your clients pre-approved and how it gets their offer accepted. And this realtor is going to give you guys some tips on your house, what to do to get that extra dollar, top dollar, the do's and the don'ts of selling your house. So have a good night, everybody. I'll see you all soon. And again, if you have anything, please reach out. Thanks, team.